One of the most powerful ways to accumulate wealth is through organizing information. And I'm going to share with you the kind of the who and what about this so that you can maximize your knowledge in order to increase your net worth. I'm Justin Hitt with Sustainable Wealth Secrets. There is a behavioral overlap with organizing information and creating wealth. It's based on accurate thinking. So if you're able to identify in the marketplace trends and directions that the market is going, you're more likely to invest ahead of these changes rather than being influenced by media and chasing trends that are going to fail soon. So for example, during the .com launch, every new company came up and said, now with now we have a website. Check out our website. Oh, we're going to eliminate stores. Out of all the companies that had .com e-commerce websites, the ones that remain are very few compared to those that were there during the hype. Once you see this hype, being able to organize information about what's actually going on, you would have more likely seen that there were foundational companies that were making money whether or not their website clients or their e-commerce clients were profitable. So that was your merchant account businesses. That was your hosting providers. That was your software developers. When I was doing my consultancy work, I focused my effort on, I work for venture capitalists mostly. I focused on government contracting, web hosting companies, and the e-commerce side, the finance side. But not the actual startups. Because the actual startups, for every 10 startups that launched, only 2 of them would actually do an IPO, and the rest of them would promise you equity that didn't turn into anything. Now, I had some peers in the marketplace that took the equity, and one day they call me up, and I'm like, hey, man, where you been? And he's like, oh, I'm in San Francisco, and I'm doing great. It turns out, basically, he got picked up by some venture capitalists, made millions and millions of dollars, spent every bit of it, and then ended up broke after the .com bubble. And this is because the venture capitalists are structuring their deals differently, and they are building portfolios and testing those portfolios against each other. And so let's break that down. What does that mean? So it's an example of using information to understand what works and what doesn't. And so the venture capitalists will raise money in a marketplace. They'll find 5 to 10 different companies that they will then invest into those companies after doing a little research in each. And then they keep track of the numbers so that they can determine how many of those companies need to be successful in order to get a return on their investment. So they are organizing information about marketplaces, companies in the marketplace, and then the dynamics of the product's engagement. Okay, that's information. That's organized information. They're applying to that accounting principles to look at how much money do they need to put out. Of that money they put out, how much return do they need to produce in order to provide to the folks that raise the money, and then ultimately what is the probability of any one of those companies doing what they need to do. Now, when I work for the venture capitalists, what I'd often do is go in and do a technology assessment, but I made some friends with these folks, and they kind of told me what was going on. They're multiplying their investors' money very reliably because of that diversity in that portfolio. So they'll have a common thread, which might be an audience or customer, and then they'll have these companies hanging off of that audience. And then when one of the companies fails, they can actually divert all the assets from the failed company back to support the remaining company that is most profitable. Again, why is that important? Where they're all serving the same audience. So if you've got 5 companies out there building an audience, they're not going to build the exact same audience out of that giant pool of target customers. But they're going to have different variations of success with that audience. The venture capitalists can take the best practices and apply it to the remaining winners, and then ultimately out the other end comes profits. Now, again, they're using media, they're using sensation, they're using that hype to drive that front end, but they always make money on the back end because they're organizing information, they have accurate accounting, and they are ultimately doing the math. So, what is the relationship between organizing information, and accurate accounting. Well, when I do a commission research study for somebody and I'm using research methods, I have to determine what is accurate and dependable information. I'll go out into public sources, I'll go into private databases, I'll go do firsthand research with surveys, and then I've got to put all that information together, and the success of that market study, the application of that market study, it depends on the accuracy of this information. Well, if you print out a balance sheet from an accounting system, your success with that balance sheet depends on the accuracy of the information in the accounting system. If we're doing a pro forma cash flow, we're looking at the cash flow over a period of time, that initial set of financial records, the accuracy of the initial financial records is going to make a big impact on the cash flow, the projection of cash flow, but also our assumptions about that cash flow. So if you're building a pro forma cash flow and you're looking at, you're going to have a 3% increase in this particular manufacturing process. You're going to have an 8% increase in labor costs. You're going to have a reduction in material costs after you hit certain volume thresholds. When you're building all that into a model, each component needs to be as accurate as possible, which is going to rely on the information you gathered, but then ultimately have to be transacted and recorded, so your general ledger needs to be clean in order for you to have an accurate free net cash flow. So when I'm talking to high income professionals and they're like, well, I'm making $350,000 a year and I don't know where the money went. Well, let's look at your bookkeeping. I don't do bookkeeping. I just make sure there's enough balance. That's fine. We don't care about your methodology. We're looking at best practices. Let's look at your bookkeeping. And very often somebody making $350,000 a year will hire a bookkeeper, and then they'll have their CPA review the bookkeeping, so you have that checks and balance, and then they're going to get a monthly spending report. And then very often they're going to get an allowance. So the principal is going to earn the $350,000 a year, and then there's somebody who's making sure there's a tax reserve. There's somebody making sure that there's money's going to the key expenses. So now you're saving all this time and effort. You can focus on your health and banking in other areas that are non-monetary, relationships and your health and things like that. And then at the end of a month, you're going to get this report that shows you not only your free net cash flow from the previous period, but forecasting out for your goals and objectives. So maybe you want to have $1 million in a cash reserve. Where are you in a relationship to that? And then ultimately, you'll be able to make better decisions. And so the conversion of income into net worth is not a magical next big opportunity. It's what foundational information do I need in order to make better decisions about my spending. And I'll tell you from my own experience, making a high income, it is easy to start spending more than you're making. It's easy to try to keep up with the Joneses. I remember a presentation one time. I'm working for a Fortune 100. One of the big bosses spent an hour on a meeting, and now this was a director level individual, and there were probably 150 people on this conference call, but they went through their Italy trip, and they showed the pictures, and they showed the adventures that they had. They showed the experiences. It was a good 15 or 20 minutes. But I know for a fact that this individual's strapped for money. I know for a fact that this individual's this trip, they've been saving for years. So even though they're making $250,000 a year, this all-out, once-in-a-lifetime trip, you only live once trip, cost them more money than they actually have. Now, that's because as they went up in salary, their home expanded, their material things expanded, there's probably, they said, oh, this is my only big vacation. This is a once in a lifetime. But when you really look at it, they have they have like 2 or 3 weeks of vacations, Disney, different parks, different adventures. Because they did not have an accurate picture of their finances, because they were not operating as an independent contractor or an independent individual, they were now beholden to the company because they basically spent every dollar they had in experiences. And there's nothing wrong with experiences, but there was a guilt that made it feel like they had to show off. Now, here's what happens when you show off like that. A lot of those people on the call realize we're wasting 15 minutes looking at the big boss's vacation that they're never going to achieve. So you have hate and discontent. You've wasted productivity time. If 150 people each have a net value of $10 an hour and you spent 15 minutes on a call, you've lost X number of dollars. And then you also have the having to keep face. I don't know quite the easiest way to explain it, but if you just showed a great adventure vacation, the next year people are going to be like, where are you going to next? Because they're going to live vicariously through you. It's so much easier to spend other people's money than it is to spend our own money. And what ends up happening is you have this vicious cycle where you get to spend more than you're making. And it's not that hard to do. So if we have this accurate information and we're able to organize paperwork and records and the knowledge about decisions we are going to make in the marketplace, then you have accurate bookkeeping, so your tax returns are on time, they're accurate, you don't have to worry about getting an audit, you're able to know whether there's any identity theft, for example. You're going to be in a better position to turn income dollars into income opportunity. You may also be able to know things like your every hour rate as well as your contributed overhead. And so your every hour rate is all the money you make divided by all the hours you have. And your contributed overhead is what is it costing you to live? What is the net of your earnings? And in many cases, clients have done this exercise, and this is actually this is part of a packaged exercise, but they've turned out that for every hour they work, it actually costs them. So for every dollar they make, it actually costs them $1.10 to make it. So for every hour they work, they're actually getting poorer and poorer. So we were able to take this now new knowledge and identify where might they have residual streams of income, where might they have more efficiency in their investments. One client, we sat down and noticed that the brokerage firm they were working with had a 4% commission rate, plus they were investing directly into funds that were their own company funds. So the effective expense on their investments was 10% per year. So they had a lot of money in the bank, and they were getting these 1% and 2% returns, but 10% of the expense, or their expense was 10%. All we did, rather than having an active brokerage, is transferred all the money into a balanced portfolio that had index funds. They ended up with a 4% return pretty consistently around, wasn't spectacular. They didn't have the huge jumps that the brokerage firm was getting for them. But when we looked at the expenses and we looked at the net return, they were yielding much higher returns with much less effort. And now the effort that they were spending sitting down with the broker and the broker calling them up and saying, hey, we've got to invest in such and such, all that time savings went into their job. And then on the long run, they were able to net more cash flow. Again, or how do you organize information? And that could be how you take notes daily. How do you absorb your situation? Do you use journaling to collect and clarify your results? Do you have a family goal or family plan? Are your records organized? And then finally, as a translation into the financial side, do you at least have good bookkeeping? Like for example, if you lost your job today, how many months, now that's a shocking statement there, how many months could you go without work? Well, most people can't go 2 paychecks without work. It's 80% of the population. If they lost their job today, in 2 weeks, they're going to be broke. And many high-income professionals are already living paycheck to paycheck. So again, this is a contrary idea. It's not on the Forbes website or anything like that. But what I found interviewing multimillionaires, working with individuals that run massive corporations and make millions of dollars a year, is that how they organize information is a reflection on how quickly they can turn their income into opportunity. The venture capitalists would invest in research papers and do a lot of upfront calculations before they make a decision. And then how they structured their implementation guaranteed that they won because of the way they could recycle and reuse information. High affluent individuals, high net worth families, family offices will set up structure in order to make sure that their bookkeeping is accurate and that they're not losing money to identity theft. They're not having wasteful spending. And I've known multimillionaires, their income per year is literally $1 million gross. This is not their company's income. This is their individual income, that have to ask their CPA for money. But some of them have to ask because they spent all the money they got. Others ask because they want that third-party opinion to make sure they're making an accurate decision about where they're going to apply capital. It is a wealth secret that we've talked about many times, is that we want to circulate money through a system that brings back more money than you put into it. We're not spending. We're not investing. We're circulating money through a system that yields to you a higher free net cash flow than you put into it. So $1 in, you want to get $2 out. We want to know where in your life you're getting $1, but it's costing you $1.10 to engage. We want to look at different ways of structuring. We want to look at how we're utilizing talent. The biggest objection people have when I explain this to them, or we do a seminar or a workshop, or we're talking about this in coaching, is that it sounds like a lot of work. But the analogy that I often give is that, let's say IRS auditors showed up at your house today. Could you bring them into an office and then bury them with accurate and consistent records? See, a CPA or an auditor that looks at records, and my background, again, is risk management. I work with auditors. I do control validations. When a regulator or an agent comes, like an IRS agent comes, and they sit down with you, and you can hand them reports, receipts, justification for large purchases. You can hand them records in a nice, neat format. You go into your paper tiger, you go into your record-keeping system, and you hand them a box of records. They're going to be happier, and they're going to understand that it's hard to find the mistake. A lot of people think that if they have poor records, they can hide the mistakes. But you're only hiding the mistakes from yourself. Today, you can just pull somebody's credit card transactions, or you could, you can get in trouble for using too much cash. If you're buying cars with cash, even if you're a car collector, somebody's going to be looking into that because there's anti-money laundering laws. So again, there's a direct relationship between how you're able to organize information to make better decisions, to jump on opportunities before they're peaked out or hyped up, to make better decisions about your finances. It may seem restrictive and to a point where you're going to get an allowance, but ultimately what we're talking about here is turning your income, no matter how large or how small, into wealth, which creates more passive income, which therefore increases your income again. You will have an income problem with this of either too much income, and now you've got to build in structure to reduce your taxes, but you'll not have a problem where you don't know where the money went, or you miss an opportunity, or you're frustrated and make a bad decision, because there's a direct relationship between how you organize information and your ability to make great decisions, especially when it comes to money. I'm Justin Hitt with Sustainable Wealth Secrets. If you want one-to-one coaching, or you have specific questions that you'd like to see me address in a group coaching call, then visit www.sustainablewealthsecrets.com. You don't need to be a member to ask questions, because the majority of the podcasts come from your questions. This is viewer supported. There are no commercials here. So you go to the website, you ask your questions on the contact page. Make sure you're part of our free email newsletter so that I can let you know when new content becomes available. And we're here to help you transform business relationships into profits, to turn more of your income into free net cash flow and net worth. And yes, you can do it. It doesn't matter what's going on with inflation. It doesn't matter what's going on with the economy. If you have accurate information, organized records, and tools to make decisions, you will always succeed. Thanks for listening.